Welcome to CrushTheStreet.com's weekly market wrap-up. We'll start things off in the equity sector, which has seen some lethargic days following Helicopter Ben's announcement of quantitative easing Part 3. Actually, the more appropriate acronym is QEI, as these aggressive measures have an indefinite time span. However, somebody needs to tell that to the bears, who may be down but are certainly not out. Today's market action was mixed, with the S&P 500 and the Nasdaq posting marginal losses, while the Dow Jones barely tweaked a gain. Mainstream analysts often point to the fact that the indexes are holding near all-time highs, but the historical context paints a different story. If we look at the Dow Jones 3-year technical chart, we see that in November of 2010, when QE2 was announced, the index made large, consistent gains well into the middle of January before correcting. Ultimately, the difference between the announcement of QE2 and its subsequent rally was a gain of about 12%. So far with QE3, we are basically in a holding pattern from last Thursday's big boost. There's been some down days, some up days, with a net gain of essentially zero. Also note that the volume during the QE2 rally remained relatively stable. But since the fall of 2011, the volume has been declining noticeably, and QE3 appears to have only a marginal effect. But the real question is, where will this quantitative carpet ride take us next? If we were to have that 12% gain that was seen during QE2, we'd be looking at Dow 15,000 sometime in March of next year. Now, you need to ask yourself, is such a rally realistic given the macroeconomic conditions we face? To me, the market action is answering that question with a belabored no. One of the key points that came up this week was the FY13 forecast downgrade announced by FedEx. As you all know, market analysts take a keen look at FedEx and its competitor UPS, as both companies provide a real-time, boots-on-the-ground assessment of the economy. FedEx stated that their customers are seeking cheaper alternatives due to slowing worldwide demand, and this is one big reason why I remain long-term bearish on equities. No matter how much you rearrange economic deck chairs on the Titanic, the performance metrics of major logistics companies don't lie. After all, if the glove don't fit, you must acquit. Now, 2 weeks ago, we discussed the very real possibility of serious declines for FedEx, and I came up with that forecast using trend channels, which is a significant part of the Elliott wave theory, a popular method of technical analysis. I say that it is popular because much of the analysis that you see regarding precious metals use Elliott wave theory, whether they know it or not. While I don't have time to go over all the details, Elliott wave theory incorporates patterns, ratios, and time to define and identify market trends. The price patterns are considered the top priority by Elliotticians, and this is where you will see many analysts and bloggers plot out trend lines, pennant formations, flag patterns, and so on. Elliott wave theory is very useful in visually identifying areas of potential support and resistance, and is regarded as an integral part of technical analysis, especially when it comes to defining the primary trend, bullish, bearish, or sideways. However, one of the disadvantages of the theory is that it lends itself to the realm of subjective interpretation. If you invested in silver in 2011, you likely felt that disadvantage financially. Because of this subjectivity, it's hard to use the theory to detect near-term swings in price or momentum, metrics that other methods of technical analysis are more adept in covering. We'll now focus on these methods by looking at the metals. The precious metals had a similar trajectory with the equities, namely flat and aimless. Let's start with gold. Ever since the QE3 high, gold has been trading gains and losses in a relatively tight pattern, with today's close in the 1770 level being pretty much dead even with last Thursday's close. The big psychological barrier that everybody was pushing for was 1800, right where the upper Bollinger Band, which is a volatility measurement 2 standard deviations away from the 20-day moving average, is resting. However, resistance has formed at 1780, a level that the yellow metal failed to clear this week. The upper and lower Bollinger Bands are starting to converge, which indicates a slowing of momentum and a possible near-term reversal. The MACD is also indicating loss of positive momentum, with its histogram drawing closer and closer to the zero line, while the actual price movement remains flat. Because the metals can be so finicky at times, it's hard to say whether we will have a correction here or not. Clearly, the primary trend is up, which is why a majority of technicians believe in higher prices ahead. However, 5 straight sessions of flatlining does not give me confidence, and I personally would not initiate positions at this price. Let's move over to silver. Silver, of course, has a very fanatical group of investors, and I'm sure many of them want me to give great news of an imminent rally. Unfortunately, I can't. Much of the same observations of gold's volatility and momentum shift apply to silver. Also, it had 5 sessions to clear $35, which it failed to do each time. In recent weeks, we've had ECB, QE3, and now BOJ, all of them announcing monetary easing, and all of them very much commodities bullish. So how come we're not making serious gains here? When QE2 was announced, we immediately saw several trading sessions of positive price action before a correction came. With QE3, we basically just went around in circles. While I'm not discounting the fact that we could see a major pop tomorrow using the Elliott wave assessment of a bullish trend channel, such a sentiment goes against almost every single technical indicator. History suggests that a correction is due, and we may get a sharp one, sending us back to the high 32s. Take that as a safe buying opportunity, a discounted price going into an overall wave of strength. Alright, that will do it for this edition. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit CrushTheStreet.com.